This is the morning brief from the Economic Times.
In just this last 1 week, Netflix has lopped off nearly $63 billion of its market capitalization after the streaming service reported its slowest year of growth since 2015. And we the viewers in India are partly responsible for CEO Reed Hastings' misery. Don't believe me? Hear the man yourself.
The great news is in every single other major market, we've got the flywheel spinning. The thing that frustrates us is, why haven't we been as successful in India? But we're definitely leaning in there.
Hold on right there for a second. Netflix is adding subscribers, right? Yes. 8.3 million customers to be precise in the last 3 months of 2021 worldwide. Okay? Has it changed its business model? No, not really. Okay? During COVID, when you were stuck at home, were you not streaming Squid Games or Emily in Paris or Money Heist? Yes. Binge watching, actually. Now, the company says its investment in content has been the highest ever. You bet. Several of its movies and series have swept the Oscars and Emmys. It dropped prices in India, one of its last big frontier growth markets, to get more customers, came up with a brand new mobile plan. Then, have the markets gone totally bananas? That's what we will find out in this episode. If the going's been good, then why did the stock plummet 20% in one day right after it announced its quarterly numbers last Thursday? In 1 year, the stock's down 35% and it's still dropping. It's Friday, 28th of January from the Economic Times. I'm your host, Arijit Burman. You're listening to Netflix, It Ain't Looking Up on the Morning Brief. More than what is happening today, the reason why investors are skittish is what will happen to Netflix tomorrow or the day after.
कौन?
सुनो ना, लाइफ बदलने वाला है तुम्हारा.
With me, you'll find authentic liberation. And if we ever have to pay a price for it, then we pay it.
For years, Netflix has sold its story as a growth stock that will keep adding tens and millions of new subscribers every year as they switch off their cable TV and switch on to internet videos. Like, say, Google or Facebook, Uber, and any of those big tech companies in the FANG group of companies that keeps growing and growing and growing. Yep, N in FANG stands for Netflix. Now, this has been a perfect script for a decade, taking Netflix to more than 222 million paying subscribers. To be fair, the Netflix stock has climbed 6,000% over the same 10-year period until recently. This was the only blockbuster in town.
Check out shares of Netflix soaring today, on track for its best week since back in January. The streaming giant's surge driving the NASDAQ to new record highs. First time we've seen that in a month.
But that party back from August of 2018 seems to be coming to a halt. Netflix added just 18 million subscribers to its platform last year, and going ahead, its forecast suggests it will add even fewer subscribers in 2022. This has been Netflix's worst start of a year in more than a decade. All in all, a significant decline, and this undercuts the rosy thesis around the company. Are we entering a new phase for streaming companies like Netflix where we ourselves need to recalibrate our expectations from the company?
Yes, we need to lower our subscriber estimates from the 20 to 25 level to the 15 to 20 million sub edition level for 2022. Competition is hurting them, and they keep raising prices, which is bad because all the competitors have a $5 service. So now, after the price increase, Netflix will be more expensive than HBO Max, which is widely regarded as the premium product.
Laura Martin, senior entertainment and internet analyst at Needham and Company, specializes on research on some of the largest internet and media stocks in the US from her base in Los Angeles. But Laura, isn't it counterintuitive in the sense that during COVID, everyone was supposed to be binge watching? Netflix released its biggest hit in its history. It followed up with a string of very strong releases, yet it grew at a rate below the recent average.
Yes, so great point, because they had Squid Games that released about 10 days before the beginning of the fourth quarter, and yet they added 8.3 million subscribers in the most recent fourth quarter, so the December quarter. But the year before, they'd added 8.5 million because of COVID. So part of what's happening here is that people are leaving the house. They're not watching as much streaming. And if they are, they're watching Disney Plus, or they're watching Paramount Plus, or they're watching Peacock, because those channels also are spending 8 billion, 12 billion, 15 billion a year on content. And they have cool new series they're launching with big stars or based on historical IP like Star Trek or something with a big fan base.
Right. But before we get too engrossed with the big picture of the streaming industry, I wanted to pick the brains of my colleague Gaurav Laghate, who has been sensing all's not too well for Netflix in India for a while. So has the management that's typically been quite bullish on India been this downbeat ever before?
This is definitely not the first time when Reed Hastings has spoken about not being able to be as successful as they would have projected or wanted in India. During the Economic Times Global Business Summit in 2018, when Reed famously said that given the consumer base, the next 100 million subscribers will come from India.
Right. And that became a catchphrase, I remember.
Yes. So later in 2019, he said that, company will invest about 3,000 crore over 2 years in Indian content. However, because of its prohibitive pricing, I would say, which is about 500 to 800 per month at that time, the company could not get enough subscribers. So while Reed Hastings and other top officials have always remained bullish on India and consider this as a tremendous opportunity, last year, Reed Hastings said that the company is still figuring out things in India.
So what ails Netflix in India?
So first, I would say the problem is entire strategy. It seems their only focus is on retaining subscribers rather than acquiring new ones. So all the content and marketing seems, like a direction in that. Secondly, I would say pricing, which they've recently reduced, but we'll talk about that in details. Still, it is very premium for the value-conscious Indian viewer. Third, I would say is not having one India head who is responsible for everything when you say the buck stops here. So you have all functional heads reporting into their respective global leaders. India doesn't and can't work like that. And fourth, I would say the culture of adequate performance gets a generous severance package, what they call, which Netflix take pride in that culture. And Hastings has recently written that book of No Rules Rule. But the constant fear of losing their jobs may be one of the reasons that the company has seen such a high attrition also in India. In the last 2 years, they've lost almost 8 to 10 director level executives.
Let's get hard numbers to tally with what Gaurav is saying. For starters, Netflix does not give out India-specific subscriber numbers, but as per data from media consulting company Media Partners Asia and Comscore, it is estimated to have 5.5 million paying customers 5 years after making its India debut. And where does that stack up vis-a-vis competition till December 2021? 46 million for Disney plus Hotstar since 2015. That's a shade over 8 times the base of Netflix. While Amazon Prime has around 19 million subscribers since 2016. And mind you, all this is in a year like 2021 where 102 million Indians subscribed to some streaming video service. Google's YouTube remains the Dada number one. 450 million subscribers gobbling up its free or premium videos. Keep in mind, the subscription model of the different players are also different. Let's put the numbers in perspective. Even after launching a year after Netflix, Amazon Prime has 4x the number of subscribers as Netflix. Equally distressing, both Amazon Prime and Hotstar seems to be adding subscribers at a healthy clip, but Netflix is practically flat in India. So that brings us to Gaurav's problem number one: lack of a cohesive strategy, and at the center of it all is content. Remember, content is king.
That company has earmarked about 3,000 crore to invest in both originals as well as licensed content in India in 2019 and 2020. This number is more than annual programming budgets of the top 4 or 5 Hindi general entertainment channels put together. And unfortunately, much of the content has not worked in India. When at the same time, competition like Prime Video and even Hotstar is churning out great content back to back. Even recent successes of Sony Live, what we are seeing, Scam and other Maharani and other shows. So Netflix, while they have spent so much money, they don't have that one big show to say after Sacred Games, which was 4 or 5 years back. So they don't have those big titles to get consumers hooked on.
Someone interestingly told me that they even rejected Scam, which was a script that first came to Netflix, then went to Sony, and the rest is history.
That's correct. Scam. And the interesting nugget there is that when Samir Nair, who is the CEO of Applause Entertainment, when he signed when he got the rights of the script, Sony next business head, Danish Khan, he reached out to him and he said that we would like to make the show and let's pitch it to Netflix. They actually pitched it to Netflix.
Okay.
Right? But that somehow the brilliant minds at Netflix didn't pass that show. And then ultimately Danish got the charge of Sony Live. And he took the gamble and he had conviction in the show. He pushed it on his own platform, and as you said, it makes the history. It's one of the biggest shows coming out of India.
So one is, of course, this whole original content bit. But then for a country like India, where movie stars are still one of the biggest heroes that we have, when it comes to streaming platforms, which often buy rights to show them or to stream them after the theatrical releases, would you say that Netflix being a laggard?
Again, it comes back to strategy. They signed two of the biggest stars. However, what Amazon did was a smarter move. They signed post theatrical release deals with multiple production houses, including Yashraj, Dharma, Excel, T Series, and others, which got more consumers to Prime Video. So what happened was that every consumer who wanted to watch a film just after its theatrical release went to Amazon, because Netflix, with the price points of what it was, the consumers could always watch the films in the theaters. So that was one, and they never went into the regional content library.
That's the other amazing part, because India is not just Bollywood. Why did they miss the entire regional play completely?
So I think one issue was they were first trying to focus on the Hindi speaking market, or what they thought of as the biggest market. And now, while they have started acquiring films in Telugu, Tamil, and other languages, but it's too little and too late. The problem is, again, as I said, the marketing and the entire content strategy is focused on retaining subscribers rather than going after the new subscribers. So what is happening is, once again, you have reduced the prices, but what are you following up with? And because it's a monthly subscription service, if a subscriber is not finding something new every month, he or she may not want to renew the subscription. You are coming up with content like Aranyak or Ye Kali Aankhein, which is good content, but it's not going to get you new subscribers. It's only for the people you already have. Right? You came up with a movie called Dhamaka to actually target Aryan's fan, but did you do it just after reducing the price? No, you did it 3-4 weeks before reducing the prices.
Listening to Gaurav, it reminds me of the strategic missteps that several MNCs end up making in India. They simply do not Indianize. Instead, follow a global one size fits all template, with the remote control ending up with the headquarters. Even in media, Rupert Murdoch went desi with Star only when Channel V became a success against MTV. Ask yourself this question: why is Hindustan Unilever or Toyota so successful in India? They have adapted. Netflix should also smell that coffee.
That was true up to a certain extent, which I would say till 3 years back. Now I think the current team is taking a lot of content decisions. The last slate, which they announced in, I think, March last year, the 30-40 new odd shows, that was completely decisions made by the India team. However, we'll have to wait for these shows to drop on the service first to actually make any comment on if it is working or not working.
Now, how is Netflix structured in India?
So there's no country head per se. We have still divisional heads. There are two vice presidents. One is Monica Shergill, who is the VP for content, in charge of all the content. Everyone with the content function reports to her in India. And last year, Netflix roped in Srivats TS as VP for marketing from Swiggy. So he's in charge of all the marketing. Then there are directors, senior directors for legal and other functions who all report into the functional heads globally. Right now, if you compare it with the Prime Video or Disney Hotstar or other services, now they all have India.
Next comes pricing. And I don't need to tell you, we are all hypersensitive about paying for content. Both Amazon Prime Video and Hotstar are priced much lower than Netflix.
The biggest issue with Netflix is pricing. And I remember in 2016, one very senior Netflix executive had come to India, and he told me that the service will never reduce price in India as it wants to maintain that premium status. And I had argued that it's not going to work for the simple reason that unlike US, where cable TV service costs $50 a month and Netflix was $7.99 at that time, India, cable TV itself was less than $3 a month. So you are twice of that service. So at that time, they didn't agree. And Reed Hastings famously said that their plans in India were equal to a movie ticket in a multiplex. But 4 years later, they launched a mobile-only plan at rupees 199 and recently reduced the pricing further. Well, it has worked or not, we will have to see, because I think mid-December the price slash happened. However, the issue is India is not a cheap market. It's a very price-conscious market. Netflix is simply not value for money at 500 for 100 million subscribers. It may be at 10 million subscribers. And what the slashing of price in India will do is that they may see some new subscribers who were earlier watching Netflix by sharing passwords. This is a major problem in India, right? So on an average, one 500 rupee plan was being used by 3 people. Let's slash the price of that plan to 200 rupees, and you will get at least those other 2 people who are sharing with somebody else may actually start their own subscription plan. I doubt that will happen, but even if that happens, it may give you a bump in your subscriber numbers, but your ARPUs and overall revenue are not going to increase. Hastings in our interviews multiple times has said that we will never have ads. But the point is, in a price conscious market like India, you may want to experiment a few new things. Why not? And if I remember correctly, Sir Martin Sorrell once said, I think 2019 or 20, when he had come to India, he said that he can bet that Netflix will have to start running ads.
The other issue is the nature of the beast. Amazon uses content as an additional hook for its shoppers who can also use other services like Amazon Pay and pay bills. Similarly, on Hotstar, we get to watch live sports, IPL and EPL, remember? And you can also catch up on news, so that's a wider choice.
Netflix started as just an entertainment service and they wanted to be true to it, cinematic quality on smaller screen. And while they have been true to it, and they have also started experimenting. They have recently launched games on in India, right, and other countries also. However, I think they should rather focus on content. Sports, of course, not, because that's not something which a Netflix user is looking at. Even games, for that matter, mobile games, it doesn't make sense.
Let's get Laura back into the conversation to figure out how the changes are working out. But first, we need to also understand a little more about how the streaming industry is evolving around the world. So, one would expect that a disappointing quarter from one, like a Netflix, would probably mean a pop for the rivals. But Disney and Viacom CBS, they slipped. Roku fell 9%. Discovery also dropped 5%. So are we really reaching an inflection point for the streaming industry per se?
In America, streaming is mature. And so now it's just a fight for subscribers. So that means the returns on capital are going to fall. Each of the streamers will get lower subscriber additions for premium content, and they'll all be just struggling for market share, which means they have to spend more money attracting subscribers. So customer acquisition cost is going up and the return on content spending is going down.
Right. That's why I guess markets like India or Brazil play such a big role in terms of the next growth frontier. But the worry is, the double whammy, so to speak, is that in India too, it is not growing at a faster clip anymore.
I think the issue with India is the prices are so low.
True.
So the problem is that Wall Street pays these companies on subscriber ads. But the problem is, when you add a subscriber in India, the cost is $3. And if you add a cost in America, it's $17. So it isn't. And so Wall Street needs to stop paying these streamers on subscriber growth and needs to start paying them on economic return. Like, what did it cost to get those subscribers? Netflix is doing a ton of content creation in India, but it's not getting a positive return on capital on the content spending in India. That's bad for shareholders.
But many would argue that this is a unique problem that streaming services face. I mean, you have to deliver quarter-on-quarter growth.
Well, here's what I would say about that. So before they announced the quarter, Netflix was selling at 8.3 times revenue, and Viacom, which is a competitive streamer, sells at 1.2. Fubo, Roku sells at 5. Chicken Soup for the Soul sells at 1. The issue is it was overvalued. It's too big a valuation multiple premium over other streamers. Walt Disney trades at 3 times revenue. So it was just too big a gap. Now, after this 25% correction, now it's trading at 6 times. I think it will end up trading like the Walt Disney Company at 3 times revenue. So it's just that it's okay if it slows. And frankly, their revenue growth in the fourth quarter was only 16%, and their revenue projection is 10%. What you're seeing there is the low-cost subscriber ads of India and losing subscribers in America because they're raising price.
One way to survive a slowdown is to cut cost. Is that what Netflix is planning to do?
Nope. They don't think there's a problem yet, so they are doing nothing so far. They have to realize there's a problem with competition or the economy or subscriber fatigue. I can list 10 things they could attribute their subscriber slowdown to. They don't think it's a structural problem, so they are changing nothing so far.
Because many would even argue that gaming, that's where Netflix probably has to spend billions now. And look, just the same week, Microsoft bought Activision. There's been significant consolidation. Players like Sony, they're trying to integrate their movie studio with the video game content. So Netflix, for them, gaming will become another cash burner.
Yes, I agree with that. And I like the idea of them expanding their total addressable market into young men who are the predominant demographic for video games. But the problem I have is that they're not charging more for it, which tells me there's not pricing power because it's a completely different service. And essentially, again, you're price cutting because you, Netflix, are going to spend $1 billion on gaming and charge nothing for it. You're hurting your returns on capital.
Right. So, and someone like a Facebook is going meta. So metaverse, in your reckoning, further disrupt streaming?
Good question. I think that Facebook's version of the metaverse is basically just the virtual reality goggles from Oculus. They only have 1 million users and they've sold 2 million units. So I would call that a super premium product, very expensive. My gut feel is it does not displace streaming because streaming here, we have 76 million Netflix homes. And I think there's about 100 million total unique homes here that have streaming. I don't see Oculus has been in the market for 10 years and they only have 1 million users. So I don't think that becomes a mass product.
So what, according to you, should be that moat that Netflix should hold on to?
I think they should have an advertising tier like every one of their competitors. So don't call it Netflix. They've said Netflix will never have advertising. They should start a sister service and it should have 5 minutes of ads and then only cost $5. And that would meet the price point of Discovery Plus, Paramount Plus, Peacock, and Disney. They all have a $5 or $6 tier. And that's what Netflix should do, which would open up their total addressable market. And they could put certain things on there for free. And then once people are watching that, if the people get annoyed by commercials, then they can then buy the $15 service. But you've opened up the availability of Netflix to a lot more people who can't afford what will be $17 a month after this price increase in America, which is $200 a year. Some people are too poor in America to afford that. And so Netflix should have a product offering for those homes.
Is the lack of sport also hurting Netflix? Live sports, Amazon, look at the way it's adapted to sports.
You've highlighted a very big problem for Netflix, which is it has streaming competitors that do care about the returns on capital in streaming, but Apple and Amazon do not care if they lose money on streaming because they're trying to accomplish a different goal. So the answer is yes. Amazon is a more formidable competitor to Netflix because it has sports. And Paramount Plus, which is owned by CBS, has all the CBS games on it. So that's a lot more sports than Amazon. And it has news because CBS has local news. So the answer is yes. At the end of the day, the winners will have to have news and sports and TV and film content.
In your estimate, sooner than later, they'll have to have a rethink of that strategy and adapt a one-stop shop for the viewer.
They do not have the balance sheet to only add costs. In order to add more content costs, they must have some form of new revenue. So they must have an ad-driven tier, or they need to think of something I can't think of that drives revenue growth before they can spend billions of dollars on news and sports.
Back to India, and I leave the last word for Gaurav and ask him what are the 3 things he would do if he's made the Netflix boss here.
First of all, my focus will be to how I'm getting more consumers to sample the service and trying to launch a cheaper annual pack so that I have more of a breathing space. They are on a treadmill every month to churn out new content. Then, of course, to build a team, build relationships, go out, listen to as many news stories, get the content strategy right. Problem is, whoever is coming to Netflix, they are finding the cool factor is there and they're not sure if they are meant for Netflix. a lot of Indian subscribers have told me that we are trying to search for content, but it's not something what maybe we want to watch. Third, I will change my marketing and publicity. For example, when they recently launched their Suna Kya campaign, when they slashed the prices, all the hoardings, the outdoor activity, they all had their acquired shows like your Friends and others, which again, the point is those shows are available on TV, right? Why do you want to not promote the shows which are your exclusive shows?
And your local shows, perhaps.
Exactly. Exactly. And now with HBO coming up, you are going to lose that edge that you have on others, that you pay top of the market and you get best of the content, because HBO is also going to invest heavily. So going forward, it's going to get difficult for them.
We asked Netflix to participate, but they declined. The company's spokesperson shared their perspective, though. First off, the management, he says, is betting that even if the average revenue per member comes down as a result of the price decreases, they're going to make it up in more subscriber additions. Second, every country has its own adoption curve. So Hastings' comment about India should be seen in relative terms. Brazil, for example, after being brutal for the first few years, has now blossomed. As Greg Peters, Netflix's chief product officer, summed it up, content is indeed the king.
I think we're quite bullish that India isn't fundamentally different in some way that we can't figure out how to tailor our service offering to be attractive to Indian consumers who love entertainment. We know that for sure, and so that I think gives us a lot of optimism just to continue to work away at it.
Don't get us wrong. Netflix is streaming ka shahenshah. No doubt about it. Its success has inspired every other major media company to overhaul corporate strategy to bet the future on streaming. Wall Street too has encouraged them to spend a lot of money on new programming and forego revenue from licensing hit shows to rival services. All this made sense when you're growing constantly at the expense of cable TV. But now, it's an on-demand world, and everyone, from Disney to Sony and even Apple, has got their own streaming programming menu. So it's time to perhaps tweak a strategy, add advertising, or at least a hybrid model, maybe focus more on games. Netflix stock has tanked after bad financial results even in the past, but never like this. Last Friday was Netflix's worst single-day drop in share price in a decade. And that is not a great weekend opening. You've been listening to Netflix It Ain't Looking Up on the Morning Brief with me, your host, Arijit Burman. Thank you, Laura and Gaurav, for those wonderful insights. Deeply appreciated. This episode was produced by Diya Rekhi from Economic Times and Saundarya Jayachandran from Awaz. Varun Kapahi was the sound editor from Awaz. I hope you enjoyed listening to the episode. Do send in your feedback to themorningbrief@timesgroup.com and share the episode on your social media networks. The Morning Brief drops every Tuesday, Thursdays, and Fridays. Thank you for listening. Goodbye, good luck, and have a great weekend. All clips used in this episode belong to their respective owners. Credits mentioned in the description.